Morning or good afternoon, everybody. How are you? Depending on where you are, good morning or good afternoon. Let's do a sound check. Somebody say something in the text chat that you can hear me, and we will get rocking here. There you go. Hey, Brenda, Greg, how you guys doing? Well, if your cameras are on, you can see that I'm in my little domicile up here. And you can see down there, I'm in the second story of our little dome down in California. So home sweet dome here in the Oaks. We call it Hidden Oaks. And we're up here in the oak trees in a beautiful little valley with a stream running through it because of all the rain they've been having. No flooding here, just the streams and the ponds are full and exciting. It's beautiful. So, all right, let's get started here. We have the disclaimer up in front of you that we have every single time. Charles, good to see you. Helen, good to see you too. And this disclaimer is something that you should be familiar with, but it's really important, especially if you're new. We will be doing a lot of charting today and talking about different scenarios with charting opportunities or trading opportunities potentially, but there is nothing to be construed here as advice or guidance on a particular trade. The market is risky. Everybody should know that. And we are not intending to give you any specific or tailored advice regarding any particular trades that you may be considering doing. However, doesn't mean that you can't ask questions. You can ask any question you want. I will just be careful not to give you advice or anything can be construed as advice because it's not. Okay. But you do have to learn skills to be able to chart properly, to be able to understand better what the stock is trying to tell you. And when I say that, I don't mean it literally. I'm saying that the people who are trading that stock are literally playing their cards. If you understand how to read them, it's like playing a game. If you understand your competition, you understand how they act, when they reach up and scratch their nose on the left side and blink, it means something, right? It's called a tell. The way the market moves, the way the traders interact, if you watch closely, you can begin to start seeing things that you can recognize. They're tells. There's general tells, and then there's very specific ones. So these are things that we wanted to talk about today. And so if you understand that, what do you mean you can't see my screen yet? That just simply means that, hang on a second here. The menu, there it is. Okay. Let's try this. All right, thanks for the catch on that. I thought that it was already showing, and apparently it's not, so that's fine. It was up on my screen, and so made a false assumption there, I guess. All right, let's do this just a little bit differently. Anyway. Yeah, let's do that right there. All right, first and foremost, let's just make sure that we're interacting correctly here. The screen that you're looking at should be the chart. Please confirm that with me here. Okay. Jennifer said she saw the disclosure. You should have seen it because that's what everybody was seeing. Oh, Alyssa was just saying we couldn't see my screen share yet because I wasn't sharing, but as long as you saw the disclosure, that was the important thing. All right, very good. We're good. We're good. We're good. All right, guys, please pay attention to content that Rob is producing and laying out on the calendar. The calendar is very important. There is so much work that goes into it. Every time I do this, I give props to Rob because I know from personal experience how hard it is to produce content. And if you haven't done it, you just have to take my word for it. It's a big deal. It's something to be appreciated. Thank you, Rob. Okay. All right. So first, let's lay out kind of a format for today. We are going to be doing a lot of charting, on-screen work here. This is going to be our, we're not going to do any slides. We're going to do this and some screen sharing and some annotating on the screen. And that's the way we're going to do class today. What blink here? There we go. So with that, confirm that you can see the screen here. What we're showing is the SPX, showing the S&P 500 right now. Yes, just to confirm. I think it's already been confirmed, but just say yes, because I switched screens and came back. Okay, very good. All right, S&P 500. This goes back 3 years. You're looking at 3 years right here. And I argue that the S&P 500 is the best metric for monitoring the stock market. The reflection of arguably the best or the top 500 companies in our markets is a much better reflection of the market than than the Dow Jones 30 or the Nasdaq 100. This S&P covers stocks from the Nasdaq and the Dow and all of the indexes essentially. And anybody who's anybody is going to be on the S&P 500, and anybody who is trying to be somebody is trying to get on that. And if anybody ought to be on there, they're trying to do that. They're working on trying to get there and get on the S&P 500. This is the big board. I don't care what they say about the Dow. This is the big board as far as I'm concerned. So when we look at this over the last 3 years, you're going to notice first and foremost that there is a baseline. There's an uptrending baseline that has just been confirmed as of about 3 months ago with that last dip on the line. That last dip on the line is the third dip on the line. So there's a number of things that I want you to pay attention to and jot down and or remind yourself. And sometimes the best way to remind yourself is to write it down, because maybe the last time you said, oh, that's really good, I'll just remember that. And now you're going, oh, that's right. If that happens, anytime you hear yourself go, oh, that's right, or oh, yeah, that means you didn't write it down and internalize it yet. No problem. It takes 5 to 7 times. 5 to 7 times over the same material, having an aha experience before you completely internalize it or hold on to it. So there's absolutely nothing wrong with repetition. There's nothing wrong with going, oh, crap, I remember that. How come I forgot? I remember hearing that. I was going to do that. It takes 5 to 7 times. So don't beat yourself up. It's normal. Okay, it's normal. So as you go through, jot things down. When you have a aha moment, jot it down. Okay. All right. It takes 3 points to create any kind of a pattern. 2 points is a line. A line is not a pattern. A line is nothing that you can do anything with one exception. Okay. If you have 2 points at the exact same price, you could argue that that might be significant. If they're separated by some distance and you have an action that happens twice, it might have some significance. Generally not. Generally, any 2 points is just a line. It's not a pattern. The exception would be when you, okay, so tell me if the board just switched to a whiteboard. If I did this right, we just switched to a whiteboard. If it stayed on the same screen. Yes or yes? Okay, perfect. Okay. Let's say that you had a price movement. Something happened, and let me get the tools to come up here. There we go. All right. Let's see. Go. Hang on. There we go. Just trying to get the eraser. Whoops, come on. There you go. Okay, here we go. So if you have a price action and it comes back up and it does the same thing, that's 2 points. You can draw a line through that. Is it significant? Maybe. Maybe. Because something happened at the same point twice in a row. Okay. If you look at a stock anywhere here and you say, I'm going to draw a line between this point and this point, all that is a line. It's 2 points. It doesn't necessarily mean anything. These 2 points doesn't necessarily mean anything. If you have something that goes like this, it bounces, comes up, reverses down, bounces again. These 3 points now suggest something. It brings into play the possibility. So I'll use dotted lines as the possibility that if something happens right here, now you can say 1, 2, now you've got a pattern. Okay. But 2 points almost never does anything significant. There's just too much. There's too much there or there's not enough there to draw any conclusions. It usually takes 3 points to begin a pattern. That's why when we have an uptrend, we tend to have 1, 2. If we look at the big picture, there's 1 rotation, there's 2 rotations, there's 3 rotations. Patterns tend to go as a habit or as a matter of fact. They kind of habitually go 3 to 5 times and then they break down. 3 to 5 times and they break. So on the third pattern, you say, okay, we definitely have something now. We have 1, 2, 3, 4. There's our confirmation. Now we start looking for this. We start looking for this. We start looking for this. And we count the rotations. 1, 2, 3, 4, 5. These are bonus rounds. It is very common for some stocks to do rotation patterns. 1, 2, 3, and then they break down. Okay. That's fairly common. To get a 4th and a 5th, some stocks it's common. In general, it's not. But if you get 1, 2, 3, 4, 5, this is a very common pattern. What you wind up with now is a wedge or a triangle as you complete the 5th rotation. 1, 2, 3, 4, 5. What this means is that it is very common to have difficulty squeezing out the last couple of rotations. All right. When I do push-ups, let's say I've got I'm challenging myself. I'm trying to do 50. I'll put 49 push-ups. Okay. The first 10, no problem. 20, can't tell any difference. 30, we're about 95% at 30. We hit 40 and that drops down to 50%. And those last 5 will grind out, the last 20% of my energy to try to grind out those last 5. I got my 49, but the last 5 took a lot more work than the first 10 or 20. Got it? So that's why you see patterns with a push, and then a push. But if you get a 3rd one, then the 4th one is usually weaker and the 5th one's even weaker. Yeah, my uptrend, which is controlling the uptrend, my uptrend line, the support line, yeah, it's holding, but I'm showing weakness here. And it's getting harder and harder to bounce back up. And usually, not always, usually that breaks to the downside. Okay, that's just the way it tends to go. That's the reflection of human nature in the market. It truly is a reflection of human nature. That's just the way we do things. So when we look at the S&P 500 over a period of 3 years, we see now we have 1, 2, 3 rotations or bounces off of the uptrending support line. All right. In the big picture, we have 2 rotations under our belt. We're working on the 3rd one. The first one is the great big one. That one took 2 years. So on the big picture, that's a 2-year rotation. It's a huge run up without any significant reversals until we got to January of 2022. So we start over here at February, March of 2000. And we get almost 2 years down the road before this thing rolls over. And then it rolls over and it takes a year to roll down and then recover. Well, we certainly weren't playing a pattern at that point. We're playing the smaller patterns in the short term. We're playing all the smaller patterns, but small patterns morph into bigger patterns. And well, not always, but most of the time they do. So what you're looking for, guys, is, you've heard me say many times, if there's no pattern, there's no trade. So over time, several small patterns will start to morph into a big pattern. That's not uncommon. What is that? What value is that? Well, it shows you that the big picture is being formed, and it will impress and imprint on the smaller print, the smaller time frame, the smaller picture. And the smaller rotation, the smaller time frames build into the next leg of the big pattern. So it's a little bit like the Russian nesting dolls. You know, the big one has a smaller one inside and a smaller one inside of that and a smaller one inside of that. Those type of nesting patterns of the little ones fitting into the big ones is not uncommon. It's not mandatory. It certainly doesn't exist all the time, but it is not uncommon. When you have a pattern, guys, it's easier to trade. If you find a stock or an index that you can find the pattern, it definitely makes it easier to trade. And that should be something that's not even a question or not argued at all. If you can find a pattern, it's easier to trade. That's why I say, if there's no pattern, there's no trade, because there's plenty of stocks, indexes that do have patterns. Why spend your time working on something that that doesn't have a pattern? You know, if there's no pattern, don't beat yourself up trying to find it. If it's not there, go on to something else. Find something that does have a pattern and trade that. Okay. So this is the big picture. Backing up just the last couple of years, if we go here to the rotation top, one more all-time high. We have, and this is the first of the year in 2021. We are at the first of the year in 2024. So there's 3 years from here, that vertical line moving to the right. As we move down off of that uptrend, we started to develop, you can see this nice blue line, this downtrend. The downtrending line, or the resistance line, is the control in a downtrend. What we do once we start to see a pattern that we can identify here at this scale, we double click that line and we're going to draw it down and we're going to lay it on the first rotation of the pattern. So you see where my cursor is right there. There was the first reversal or rotation on the pattern. When I say rotation, let me make sure that I'm not using a word that makes sense to me and not anybody else. If you've ever flown on a passenger jet, if you've ever flown in a private airplane, when you go down the runway, you're building up speed, getting enough lift on the wings until it's time to take off. In the parlance, so the language of the flight industry, that's called a rotation, because you're going horizontal and now you're going to rotate up into an angle to climb out up into the sky. So when you change a direction or an angle of attack, it's referred to as a rotation. So when we look at the first rotation, it's right there, which is about 28th of January, the end of January. And it rallies back up. Then it comes back down and it rallies at the same angle as the downtrend is starting to form. And if they're close, it's close enough. Here's something to jot down. In a downtrend, that top line, your support or your resistance line, that's the one that needs to be respected by the trend. If there's a pattern, you'll see that respected. On the top, where I draw the line, the second and the third hit on that line go past it slightly. They're still in the same neighborhood. That is not a default. That's not a defect. There's nothing wrong with that. If they're close, they count. This is like horseshoes and hand grenades. When you are at the other top or the bottom of a range, which in this case would be the support level is plus or minus on a pattern. In a downtrend, the support level is plus or minus. In a downtrend, that resistance line on top needs to be hit. That needs to be respected in order to continue the trend well. So now you can see the next one, we pushed down into May and June of that year. And we see that rotation pushes down farther. If we zoom in on it a little bit more, and let me back up on this. There we go. You can see, interestingly enough, it pushes down another W double bottom pattern. It reaches back up to where the line is, and it pushes back up in the pattern, drops down even farther. And if we wanted, we could chart this little escapade out all by itself, but we see that it rallies, it comes back up, and boom, picks up our trend line, which is the resistance line, comes back down. We push down another double bottom, and we rally back up, boom, to the same line. Then we push down, and we come up and hit it for the 5th time. And then it pushes through, and we break the pattern. It pushes on out. Let me extend this down just a little bit more right there. We get the tap out where you use the old resistance as new support. You break out of it. You come back down, bounce on it a little bit. It holds, and off you go. It's like a springboard pattern. Okay. And that's what this is right here. It's a very common behavior. So to kind of show you again, in a downtrend, we're going to push down right there. Now we start to develop our parallel line. This can be plus or minus. Okay, come back up. Boom, that one's a little bit short. We hit it again. So there's 1, 2, 3, 4 hits on here. The rotations are 1, 2, 3. That's the pattern rotation. The taps on the line, we've got 4. It's not uncommon to do something like this. So now you're starting to build a wedge as you get into rotation number 4, and we break out. Coming back down, testing this from the upside. Okay, this is a real common pattern that you'll see. Number 1, it's in the same area as this horizontal support that's building. But number 2, this is a test. You'll see it bounce or tap on the line. You're testing the horizontal price support. You're testing the old resistance as new support. And then off it goes. And now we have a new pattern. We start looking for this. We let this, which is a parallel line. Say, well, what happens in this one? It was a breakout. Yes, it was. Well, you know what? We're going to do this. We're going to draw another parallel line. And this becomes what I refer to, guys, as lanes on the freeway. And you're going to see it as we go through some charts today. These are lanes on the freeway. You'll have a breakout here. And all that defines is watch out for this because, oh, look at this. We test the same. And then we pop out and we push up again. Aha. This happens very often. And you look at that and go, wow, look at that. It's like magic. Yeah, it kind of is, but it really isn't. Okay, it's not magic. That it is something to pay attention to. Now we have 1, 2, 3, 4. There's our 5th rotation. This is getting long in the tooth. You see it drift in like this, maybe into a little wedge pattern, and there's a break. Now we start a new pattern to the downside. This is a very, very common process. It's so common that we develop expectation. We develop rules, and we say patterns tend to go 3 to 5 times and they break. Why? Because they tend to do that. It's rare to go more than 5. It's more common to do 3 and 4. 5 is less common than 3 and 4. So, but we see enough of the rotation to 5 that we put it in there. But guys, it's just like anything else. It's like doing the push-ups. The first 10 is okay. The first 20 is okay. 30 starts to get a little bit iffy. 40 goes, oh, wow, I'm killing myself. And by the time you get to 45, you got nothing left. Okay. If that is something you can relate to, that is something that is very real. Now, let me give it one more different explanation of that, and we'll go back to the chart. Is pushing a stock like lifting weights? Is it heavy? Does it make you tired? And the answer is no, not necessarily. But guys, every time the market pushes up and rolls back like this, there's an interaction going on between the A, the B, the C, the D traders. The A traders are the alpha. It could be a 1, 2, I'm not going to put a number on it, but it's typically, it can be a single person, or it could be 5 or 6 people. I'm just going to say 1 to 5. There could be 1 to 5 key players in a particular stock that have it so dialed in that, and they can move enough product that they can manipulate turns. They don't manipulate the whole chart, they manipulate turns. The B traders are busy little bees. I call them busy little bees because they are alpha traders in the making. They want to be alpha traders. They wish they could be. They may even think that they're part of this elite group, but they're not. They're able to spot what they do and they follow. This is big money. Okay. Boom, boom. Here's where the magic happens, guys. It's the C traders and the D traders. This is the public. These are the different levels of the public, kind of the informed active trading, and then the impulse knee-jerk trading that goes on with people who see the market's been going up for the last 3 months and I'm missing out, or it's going down and I can't stand this any longer. I'm selling. This is the heavy lifting. The C's and the D's do this lifting right here, from there to there. It's the A's and the B's that manipulate these tops and bottoms. The A's and the B's do this stuff. Not all by themselves, but they initiate these turns, these reversals. The C's and the D's are the ones that carry it until it runs out of gas. So if you're manipulating the market, if you're doing it with fear or you're doing with the fear of missing out, either one, fear of losing, which is going down, or the fear of missing out, which is the market moving up, when you move this up like this and then you run out of the push and you sell off and you can sell it down, but if you can sell off the market and the buyers are willing to come back in at a higher price, no problem. They'll switch and let the buyers come back in and carry it on up and see what's happening here. They'll push a little farther in the next one until they run out of gas, and then the A and the B guys put the pressure on to turn downside. The C's and the D's panic out at different levels. If they come back in though a little higher because they're still bullish on this, well, you can see the pattern developing. Now on the next one, it's possible that they push up into another higher high. See what's happening? That's great. And the A's and B's are waiting for them here. By the way, the A's and the B's are the ones who, as soon as the selling pressure backed off, bought back in and turned it back up, and the C's and D's came back in for one more round. And now they do it again. And as it goes down, the C's and the D's now have been hurt 3 times. This is the 3rd time that they have been killed. Okay. They've sold out, panicked out, lost money, but the market keeps moving up. So they're willing to come back in. But at some point, the pain gets a little hard to bear. And when Johnny says, Mommy, it hurts when I do this, Mommy says, quit doing that. Okay. So maybe Johnny decides he's not going to do that. And he pushes up and he goes, I got killed on the last one. I held on too long. I'm selling out early. And so if the buying pressure backs off a little bit early, the A's and B's jump in and they turn it back down. But as they turn it back down, maybe the C's and the D's are still got one last push. And if there's not much selling there, not enough, the A's and the B's will say, well, let's try it up again. And if it fails 3 times right here, the A's and the B's are going, you know what? The C's and the D's, they got nothing left on the upside. We can't talk them in with enough energy to get any kind of a push. Let's scare the crap out of them. Let's scare the heck. Well, sorry about that. Well, let's scare the heck out of them and see if we can really get them to panic. And so this A's and the B's, instead of pushing it to the upside, if they feel like the upside pushes over, they'll turn around and sell heavy. They'll short heavy, try to break the pattern. There's enough people watching, in particular B's. If the B's see this pattern being broke, because they're smart enough to watch it, they follow the A's. But if they see that, they'll jump in. And that will start some of the C's who've been paying attention because they've been hurt on this last pullback. If you on the pullbacks, there's some of them are going, I'm not going through this again. I'm out. And so the C's will start in a little bit early, the D's follow, and boom, you get a big sell-off. Okay. That's one explanation. There you can change this pattern, change the explanation. But if you see this looking like this, it is not unrealistic what I just said, that you would interpret this just exactly this way. It gets harder to get the third and the fourth and the fifth rotation because it's harder to manipulate a public who can start to figure out we're being manipulated. The public starts to figure out, hey, it hurts when I do that. I'm going to quit doing that. I just figured out when I take this frying pan and I smack it on my forehead, that really hurts. It takes a while to heal. And after about 3 times, I'm going, I don't think I want to do this again. All right. And that's not too far of a stretch of what happens in people's minds. They're going, I'm tired of this. I'm getting whipsawed. I'm just going to sit this out. I'm going to sell out and quit this stock. I'm not going to play it anymore. And that's fine. The A's and B's will drop that price because at some point, that stock, if people like to play it, maybe it breaks down here. That doesn't hold. It breaks down here. This one doesn't hold. Maybe it gets down to here and people are going, dang, look at that price. I remember back here a year and a half ago, I remember when we bought into this and we rode this thing up. That was great. It's down here again. And it looks like it's maybe starting to turn again. I think I'll try again. So after the pain wears off, the C's and the D's will come back in because it's such a bargain and they remember the good old days. And then off we start with the next rotation. Guys, it is human beings playing this. Yes, we have automated, computer-driven algorithms. I know that, but they're written by people and they cause reactions of people. We don't have algorithms intimidating and scaring each other, although I don't put that past AI. But right now, there's still human interface driving this thing. Okay, give me some feedback. I've been talking too long. Does this make sense? I want to have this kind of image and this idea in your head before we dive into the charts, because I want you to see this is actually what's going on. So I need some raised hands or some, yeah, I got this, or yeah, I'm tracking. This makes sense. All right, good. Charles has heard this many times from me before, and he said, yep, it works for me. It does work. Yep. Brenda says, yes, it's a refresher. It's always great. Yes, it is. Repetition's the mother of skill. All right. And not everybody in this class is at the same level. Okay. Charles and Brenda have heard this before. That's great. But not everybody. So everybody needs to hear it several times before they internalize it. That's just the way it is. Joe says, what indicators would confirm? Okay. There is about 100 indicators, and there's various different, what I would call perhaps, I don't know what would be a good word for that. You know, things like Fibonacci's is a way, it's a tool, or it's a process. There we go. It's a process of looking at the market. It's a methodology. That's the word I was looking for, a methodology. Okay. There's different ways to do it. Some people will trade just with indicators. Some people trade just patterns. They don't believe in indicators. They just trade patterns. Guys, for the most part, in fact, I'll make a bold statement. There is no such thing as a leading indicator unless you're talking about price itself. Price is the leading indicator of price. Okay. But there is no such thing as a leading indicator. All indicators are smoke coming out of the back of the airplane. If you look at the way the indicator is made by collecting data and evaluating that on a pattern. But it's not leading because nobody knows where the price is going to go tomorrow, next week, next month. Nobody knows that. They may have a disposition, and you might even be an A trader to where you feel like you can kind of do some price manipulation, but nobody knows for sure where it's going to go. Therefore, you can't have a leading indicator. You can have a predicting indicator. So Joe, write that down. There is no leading indicators except price, but there are predicting indicators. And the predicting indicators, some of them are really good. Okay. Brenda said, where'd your face go? I just turned my camera off. I want you to focus on the charts, not me, Brenda. I didn't go anywhere. I'm right here. I just, she's laughing. Okay. Um, so anyway, I want you to look at this S&P chart, and I want you to look at lanes on the freeway. Okay, you can see I just added a third line here, and it does not appear to be just random or casual. This is the angle of attack. And when you break out of that pattern here on the support line, that will tend to be, it sets a new mark for following or subsequent rotations to the downside. And you can see it, it sure looks like it fits here. Sometimes we can even find even more lanes on the freeway. And so I'm going to slide up here and look for a significant point on this pullback, for example. Okay. Is there any correlation here? I think so. I see it. You know, on this first rotation, it came back up to here. Then we traded 1, 2, 3, 4 rotations down. Then we came back up to the same place, hesitated. Then we pushed back up, pulled back down to the same area. Had some price action there for about a week and a half, almost 2 weeks there. And then we push down to this lane. Then we push down here, come back up, push down, hit this lane again right here, come in here, back up in here. We hit it again, fight through it. Same range on the top side, come back down, fight it again, down to this lane, back up to this lane, down to the outside here, double bounce, come back up, tap on it, up to here, hesitate, up to the top, triple top, pull back, and here's our wedge forming on rotation number 1, 2, 3. There's our fourth one. It's weak, and we break out. Okay, not a coincidence, guys. It just isn't. Let me show you on a little smaller scale coming up out of here. Here's our breakout rotation. Let's see. I don't want to do that. Let me just get a line. Here we go. So we break out of here. There's our breakout rotation. We lay this line up right through there, and we double click on it and see if we have any correlation. Bring this up, and we go, oh my. Okay. Not a coincidence. There's our rotation. There's the pattern up. There's the break. And down we come. So what we see, and a great question that Mauricio says up here, he said, are these types of patterns best caught on daily charts or longer time frames? And the answer is, it depends on the time frame you're trading, Mauricio. It depends on the time frame you're trading. Now, if I'm trading daily charts, I want to chart daily. I will look at a monthly chart, but not to make trading decisions. So in other words, I will look at multiple time frames, but I look at them for feedback. I look at them for perspective. If I'm trading daily, I make my decisions off of the daily chart. All right. I will use a monthly or a weekly chart to get the big picture, to stand back from it and see the big picture. No problem. I'll do that all day long. But my trading, you come back down to the time frame you're trading. Does that make sense? Okay. Les, it looks like Les, but then there's an I there. It's kind of interesting. Comment: planes crash, CEOs get indicted, pandemics come along, etc. Yes, they do. They do. But that's a good comment. Tell me why. Why did you make that comment? What were you thinking? Just give me a little so that I connect with what you the point you're trying to make a little better. Mauricio said, yes, use the other time frames for confirmation of the trend. Yes, and sometimes bigger pictures. I mean, there's a lot of good things you can get out of it, but you don't make trading decisions off of that. Okay. Yes. Okay, yeah. We can't predict because nobody knows for sure. Guys, if you have not seen, I believe, oh gosh, I watched it on the airplane a couple days ago. I think maybe it was Netflix. I'm not sure. If you have not seen the movie out that's named Blackberry, you should watch that movie. If you haven't watched it, you should, because we're far enough away from the technology that revolutionized communication by Mike Lazaridis. who was the real brainchild behind the BlackBerry. Phenomenal movie because it shows the meteoric rise and the almost catastrophic fall of some of the biggest companies. You know how a company can rise so fast and how it can fall so fast. As Les says, planes crash, CEOs get indicted, pandemics come along. In the case of BlackBerry, Steve Jobs comes out with the iPhone. You get a perfect storm. Steve Jobs comes out with the iPhone, and within a week, one of the CEOs of the company gets hauled in by the SEC for insider trading or for stock manipulation. And suddenly, you've got a company that had 45% of the entire cell phone market worldwide. 45% blows up. Okay. Les says, I had a BlackBerry and they made fun of him. Watch the movie. Watch the movie. Unbelievably cool. Okay. Les said Obama had one. Everybody had one. Les, for crying out loud, were you a teenager or were you an adolescent at the time? Everybody who had anything smart, it was the first computer, it was the first smartphone in existence. Everybody had to copy what Les Lazaridis came up with. It was brilliant what he did. Nobody had ever done it. Nobody had. Jack, you know, in the movie 24, Jack had one, and that was the coolest thing. What they were able to do with that BlackBerry, the stuff they could send to him encrypted. It's amazing. Charles says, I've worked on large aircraft my whole life, and it is never good when smoke is coming out of the back of an airplane. Okay. Charles, you got me. When white vapor, water vapor is coming out of the back, when you have a contrail, that's not such a bad thing. Okay, that's what I meant. But that's an excellent point. Nice job. But a contrail is different. And so what I'm saying is that it's easy to follow the contrail and you can see where something might be headed. There's no guarantee that it will go where it's pointed. Just because that contrail is pushing across the sky in a nice straight line, it could keep going in a straight line, but it may not. It may be just ready to make a turn. You just don't know. So another adage, write this down. Find the pattern and play it. Add 3 more words, till it breaks. Find the pattern and play it until it breaks. Okay, it's real simple. Find the pattern and play it until it breaks, because they always break. And when it breaks, quit playing it, right? That's the whole point here. When it breaks, quit playing it. All right, so let's see. So what about the S&P right now? So let me give you something to kind of, I'm going to go to a weekly chart. And I'm doing this for a reason, because I want to show you on a big picture. Okay, hang on a second. I'm going to project. Whoa, a little too far. There we go. All right. Now, here's the S&P 500 on a big picture. I'm going to manipulate this just a little bit so that we can show you. Here's what I would predict in the long term. Okay. This is a prediction, not a guarantee, but this is what I would predict that we would see as market large scale control measures. These are bollards along the side of a big potential road. On the upside, this rotation right here that went from March of 2020, it ended in January of 22, almost 2 years later. We rallied and broke it back here in October of 22. And here we are in February of 24, so a year and a half later, if this pattern holds. Okay, so I'm gonna do something that is, this would make Rob nervous. Okay. So I'm going to do it anyway. But, you know, if Rob's listening, or somebody tells him, he'll laugh because I've done this many times before. But I'm serious about this. Once you establish a pattern, you can say for absolute certainty where the stock is going to go. Now, I told you at the introduction that I'm not going to give any specifics on trading or tell you that I have a crystal ball. But now I'm going to sound like the opposite. I'm going to tell you exactly where the stock is going to go. The S&P 500 will make it up to the top of this blue line. And it will come back down and it will follow and support and bounce off of this blue line right there. I can tell you for certain that it will do that. Are you ready for this? If it follows the pattern. 1, 2, 3, 4, 5. 5 words. If it follows the pattern, that's exactly what it's going to do. You see, it's a wordsmithing for sure. It's wordsmithing. Okay, I'm telling you exactly what's going to happen if it follows the pattern. And that's a true statement. That's an okay statement to make. But it's qualified if it follows the pattern. Is it going to follow a pattern? I don't know. But is it possible that I can lay out the pattern in front? And as it follows that pattern, that I could play that? Yeah, that's very possible if it follows the pattern. Is it going to follow the pattern? I don't know, but it's doing it so far. And if it keeps doing it, I can tell you where it's going. And when it gets there and reverses, I can say, see, I told you. But is it because I'm clairvoyant? No. But if I see the pattern, I can tell you what it will do if it follows the pattern. Really important, guys. If it follows the pattern. Okay, that's the mindset. It's exciting when you see a pattern develop. Now, here's the thing, and this is important. When you find a stock that does follow a pattern, pay attention, because that's something that potentially could make you a lot of money. If you can find the pattern and play it until it breaks, that's great. But what if you're playing a stock that you're trading a stock that you cannot find the pattern? Well, then quit trading it, in my opinion. Follow it. If you really like it, follow it. But if you can never figure out a pattern, do not spend any money on it because there's nothing to play. Well, my friend seems to make money and he really likes it, or she really likes it. Okay, good for them. Are they telling you exactly what to do and how to do it? If they are and that works and you can make money, great. But if you can't, don't do it. Okay. So this is a big projection if it follows the pattern. Okay. Now, if it fails here, and I'm going to reduce this down just a little bit, and keep in mind, this is a monthly chart. This level right here at 4,800, 4,810. If it comes back down and lands on that and struggles a little bit and then drops down to this blue line and then keeps going again, well, then this long-term trend is still in place. If it bounces off this blue line and heads on up again, well, then we might be developing this. We might be developing a new uptrend, but I haven't seen it yet, so I'm not going to draw the line. I'm waiting for it to show the next hand. However, there is something that might be, it's definitely on my radar screen, and that is this. If this long-term trend follows forward, I'm going to draw a parallel line right here. Okay. Then it's possible that this becomes the angle of attack for a while. It's possible that this becomes the support and resistance for the S&P as it tries to climb out of here. Keep in mind, over the last 3 weeks, we just took out the all-time high for the S&P 500. Over the last 2 weeks, we took out the all-time high. Now, will it come back down? Will it keep going? I don't know. I don't know yet. Now, somebody asked something about indicators earlier. I want to show you the only indicator that I spend a lot of time with. Everything else is ancillary. It just happens to be my favorite. I'm going to go back to a daily chart, and I'm going to show you how I utilize the MACD. Okay. Moving average, convergence, and divergence. And we will second. Escape. There we go. Go back. Whoops. This way. Okay. Now, what I want you to do is focus on or pay attention to MACD down here on the bottom. And you're going to see some little blue arrows. Those little blue arrows indicate where I see divergence. MACD is a convergence and divergence indicator. Converge means to come together. Diverge means to separate. Most of the time, MACD follows whatever the stock is doing. It's just following along. It mirrors it. Let's see. Brenda said it's already broken 5,000. Well, yeah, it was at 4,997. So today, I'm sure it did. I'm on yesterday's chart. Correct. I am. I have to be, because when I started class here, you can't update these into, minute by minute, right? So I had it updated before class. So yes, of course, it was 4,997. Therefore, there's no way in the world that they're not going to try to test and bust through 5,000 today, which they did. Okay. But what I'm looking for is where the pullback is. Where does it pull back to? Because it will. As soon as you push through a resistance level like that, a new support, it'll pull back to test. And that's what'll be interesting to me, is to see where it pulls back to test. Anyway, looking at MACD, I want to show you this. The blue arrows show you where there is divergence. Pay attention. You typically will get these 2 or 3 times a year with MACD on the settings that I use. 2 or 3 times a year means that this is not something you're going to watch every single day. However, if you find that it works, in other words, if you find that MACD is consistently right, then you pay attention when you see divergence. So here's an example of divergence. Here's the first blue arrow over here. You can see I moved my vertical line over top of that. Look here to the left. You see that big dip? MACD pushes down way below the zero line. The zero line is that line in between that runs horizontal. It's at the zero measurement. And you go to plus 100 and minus 100 on MACD. All right, so it pushes all the way down to about minus 90 on that. And then it rallies up. Okay, so when it rallies up, we come up and MACD goes above the line, and you can see down there at the bottom, it goes above the line, and then the stock pulls back a little bit. It hesitates. The stock or the index moves up higher, and MACD goes, no, I'm not going with you on that. Really? And then the index moves up, takes a surge up here, and MACD's going, nope, just not feeling it. Just not feeling it. Now, the stock collapses down, takes a big pullback. The MACD says, yeah, I could kind of feel that coming. You see, if MACD's following the stock, it should have posted higher highs along with the stock, or the index in this case. It didn't. That predicted something was going to break down. It predicted it 3 to 5 weeks in advance. Sometimes MACD will predict even within 2 or 3 weeks, but usually it's in that range of 2 or 3 weeks at the earliest. So it's an early warning signal. And then you watch the pattern to see if it develops, see if the warning came true. And now watch, stock moves up again and it pulls back. No signal, no contradiction, no divergence on MACD. It follows it down, comes back up, pulls down again. Now, keep in mind, MACD signals are only good for 3 to 5 weeks, which means if something is 6, 8, 10 weeks old, it doesn't matter. And right here, you have a peak back here. This is July 31st, and it breaks down. We come up to another peak that is in September 18th. That's 2 months later. Okay? It's almost 2 months later, which means this signal has had enough time to recorrect to the middle point and back up. So you can't compare the tops. If they're 6, 8 weeks apart, you can't compare the tops. If they're just a few weeks apart, you can. Now watch how this goes. You see the bottom? You have a nice triple bottom here. It raises up, comes back down, a little higher bottom. Those are close enough to count. Look what happens. The higher bottom is in MACD too. So it's just a green. Then the stock takes off on a big run. Now here's where the magic starts to happen. We push up to a new high. MACD flattens out. The stock pushes up to a new high. MACD barely even keeps up with it. Then we push back a little bit and shoot up to a new high, and MACD's going, nope, just not feeling it. Can you see how MACD is not agreeing with the price movement of the stock or the index here, the S&P? And then boom, down it comes. So we go, MACD's 2 for 2. Okay, we had divergence and it worked. Then a few months later, we had divergence and it worked. So far, we haven't had a divergence signal that failed. We have a big correction. MACD pushes way down, way down, comes flying back up. Now, high, pull back. So far, so good. Now, this is too far away. You don't compare these to the height of these two peaks because they're too far away. Okay, it's just the next peak. We pull back. We push up to another one, equal height. MACD's go way down. It goes, nope. It pulls back down again. Okay. So it's agreeing with it. Just agrees. When MACD goes sideways, that means the stock is in perfect mode, either climbing up or going down. So when MACD goes sideways, that means pedal to the metal. So that can be an indication, stay in the trade. If MACD is going sideways, it could mean just hang in there because it's got a perfect storm. It's really doing it. Okay, push up, pull back. There's just agreeing with the stock. We keep going. We get a flat pattern as it races up here. Right here, we go flat again. What's going on? There we go, right there. And we push up to a new peak, pulls back, new peak. Now here's where we start to get divergence again. Now watch it. There's a new peak, MAC goes up, stock pulls back, shoots up to a new high, and this is within the range here, 5 weeks. Push up to a new high, and MACD goes, nope, not feeling it, and here comes the crash. So far, we have 3 out of 3 for MACD. Okay, 3 out of 3. Now here's another one coming the other direction. Look at the dip. The stock then pulls back and it goes down deeper for another deeper double bottom. But look at MACD. The bottom is higher. So your divergence is happening right here in a bullish fashion. It's predicting bullish. And sure enough, you get a nice big rally. It pulls down, does it again. Does it again. Look at this. Look at the bottoms on MACD. The bottoms are higher. In the stock or the market, the bottoms are lower. MACD is predicting a bullish climb, and it does. You get a big rally. Comes back down. Now it's just following, right? No. Look at the market. You have 2 bottoms. The right one is lower. You push lower. MACD, the right one is higher. That is a signal of a divergence, and you get a big rally out of it. Okay, then we get a breakout. And what's happening here is we're fighting. MACD is just ping-ponging sideways, going along, agreeing with it. Get out of there. There we go. Now the stock starts to climb. We go up, we pull back, 6 weeks apart, doesn't count. But this one does right here. Look at this. New high, MACD pulls back a little bit. The stock shoots up to a new high, and MACD doesn't participate. Watch out. Watch out. Down it comes. Now here again, we got double bottoms. Right side is lower. MACD, double bottoms. Right side is almost exactly the same. I would call that divergence. That would be another example. My little arrow didn't show up there. And that's a bullish signal, and up it goes. Now, this is interesting right here. Where we're at right now, okay, so Brenda, pay attention. Where we're at right now, and I'm going to zoom in on this. Watch what's happening. MACD, we pushed up right here to these peaks. This was the beginning of January. We push up again. We take those out in February, and MACD crosses over. The green crosses the red for a bullish signal, and it's not participating. So as the market is pushed up and pushing up over 5,000, MACD is going, yeah, I'm not sure. Now, one of two things has happened. And if you picked up on this, we'll end on this. If MACD goes totally flat, this stock could be in perfect climbing mode. But it could also look out and mean divergence, which simply means at this point, guys, you've got to have your head on a swivel. Okay. And by that, I mean, we are either going to be heading into a super bullish climb for a while where it's just pedal down and it's going to climb through the roof, or we have divergence forming. So I would draw this line right here and I would watch very careful about what happens. If it turns around and breaks this to the downside, to me, that's going to be a signal that the juice isn't there, that the traders don't have it. The C's and the B's aren't willing to keep pushing this into the stratosphere. There's a lot of euphoria pushing through a big number like 5,000. There could be a push up to the top of this blue line. Very possible we push up to the top of the blue line. Just watch the top one, the resistance. Watch this bottom line. Watch it carefully. If that gets broken, the most likely target is to come back down here to 48.10-ish, right in this range. That's the most likely scenario. If that falls, if that doesn't hold, then we drop back down to a better support level where we had multiple rallies, and that would be right here. If that doesn't hold, then we just keep going down, looking for support levels, and these would be the elevator stops on the way down to watch for. Now you can throw your Fibonacci's in there, and I'll bet you're going to come up with the same spots. They usually do. Okay. How did I put the arrows on MACD? Well, I chose the arrow tool over right here, and then I just click and draw down just like that. Okay. And if I wanted to put up arrows, I could draw them up and make them different colors and whatever I want. But I just wanted to illustrate to you that in this case, in the S&P 500, you have pretty often, you'll have MACD divergence. And if you look at it, I don't see over the last 3 years a significant break where the MACD divergence didn't work. I see it like 7 for 7 out of the last 3 years. Okay, well, something 7 for 7, I pay attention to that. And right now I'm getting a signal that says you're either in perfect mode, perfect climbing mode, or this is losing gas. So all I do, if I'm in a trade, I just stay in the trade, but I'm going to be setting up criteria, real careful for exiting, because I don't want to be caught in a big swing when the A's and the B's rotate this down. And if they scare the C's and the D's, there'll be a big pullback. I don't want to ride that down in the wrong position. If I'm bullish on this, I'll stay bullish, but I've got my little spidey sense dialed up here because I don't want to get caught, right? Don't want to get caught. By the way, watch the movie Blackberry. I think you'll like it. What program? This is Omega Charts. Okay. This is Omega Charts. All right, guys. Take care. God bless. I hope you had a good time today. I did. I hope you took some notes because this is some basic stuff, but it's stuff that bears repeating. It's stuff that you've got to be able to have, dialed in. It's just, you're welcome. Jennifer, I appreciate that. Mauricio, thank you. Charles, everybody, thank you. Brenda. All right, guys, take care. God bless. And we'll see you next time around. Bye-bye.